You built a strong real estate portfolio. Maybe it started with a single rental, maybe it grew into a string of commercial properties. Either way, you spent years doing the hard work of owning, managing, and growing your real estate equity, and now you're thinking about the next phase. Maybe you want to simplify. Perhaps you want consistent income. You might even be ready to retire or at least take a step back. But then the tax math hits. When you sell a property, you're facing capital gains tax, depreciation recapture tax, state capital gains tax, which many states treat as ordinary income, and in some cases, net investment income tax. These taxes can wipe out 30 to 40% of your gain, which raises the question, how do you exit strategically without triggering a massive tax bill? That's exactly when the wealthiest real estate investors turn to a powerful but often underutilized tool, the 1031 exchange. And for investors looking for true freedom from real estate management, the 1031 exchange utilizing Delaware Statutory Trusts, or DSTs. DSTs are investments that are varied across virtually all real estate asset classes and allow for simplified, hands-off real estate ownership, deferral of depreciation recapture and capital gains taxes, and enhanced income through monthly distributions. In this video, I'll show you how sophisticated investors use 1031 exchanges in conjunction with DSTs to preserve equity, reduce the burden of management, and generate income while potentially scaling up to higher quality real estate holdings that even wealthy individuals can buy on their own. You spent your life building wealth through real estate. You should be forced to give 30 to 40% to the IRS. Hi, I'm Ryan Glasgow, founder of Glasgow Investment Solutions. For over 20 years, I've worked with real estate investors, high net worth individuals, and business owners to create customized strategies for building and preserving wealth, especially through 1031 exchanges, DSTs, and alternative investment solutions. If you're looking for ways to grow your wealth while mitigating taxes, enhancing returns, or reducing risk, this channel is built for you. Please make sure to like, comment, and subscribe for more strategic insights like this. Many investors are unaware of the crippling taxes that come with a real estate sale. Owning real estate is not easy. You have to save and due diligence the properties before taking the risk to purchase them. And once acquired, the work really begins. You have to manage the tenants, pay for maintenance, repairs, and insurance, not to mention weathering the stress of market swings. And then, right when you're ready to reap the benefits of your hard work, your CPA runs the numbers, and you're potentially facing hundreds of thousands of dollars in taxes, some of which you were unaware of. You have capital gains tax on the depreciation recapture tax, which can be up to 25%, state taxes, which are taxed at the same rate as ordinary income in many states, and for some high-income individuals, the 3.8% net investment income tax. In my career, I've worked with investors who are staring down large tax bills, some north of $1 million, just for selling a property they'd already spent decades owning. One client said it best, "I don't mind paying my share, but losing a third of my gain after all this work and risk, it doesn't feel like a win." And they're right. In most cases, they didn't need to sell the property. They just wanted less complexity, more income, and a break from the taxes, tenants, and toilets. But if you sell without a plan, the IRS will take its share whether you're ready or not. That's why the most sophisticated investors don't just sell, they exchange. Here's how a 1031 exchange works, and unfortunately, where most people get it wrong. A 1031 exchange is named after Section 1031 of the IRS tax code. It lets you sell one investment property and reinvest the proceeds into another like-kind property, all without paying capital gains taxes or depreciation recapture at the time of sale. This is not a risky loophole created by aggressive tax professionals. 1031 exchanges have been part of the tax code since 1921, over 100 years. This legally recognized strategy has helped generations of investors grow, reposition, and consolidate their portfolios while deferring taxes. Here's how it works. You sell your investment or business property. Instead of taking the cash, you must work with a qualified intermediary, or QI, which is also called an accommodator. These are the people that hold the funds in an account somewhat similar to an escrow account. You then have 45 days to identify a replacement property and 180 days to close on the property. If you follow those simple but stringent steps, you can defer all taxes indefinitely and sometimes permanently. Again, the steps are simple, but all too often investors make heartbreaking mistakes that nullifies the exchange. One of the major mistakes I see is waiting too long to plan. I've seen it over and over. Real estate owners got the opportunity to sell their property at a good price and figured they would plan the exchange after the close. This just doesn't work. With a 1031 exchange, the planning must be done before the transaction happens with a qualified intermediary, or QI, ready to receive the sale proceeds. The technical term you may hear is constructive receipt. In layman's vernacular, it simply means taking possession of the funds. If an individual does this for even a day, the exchange is blown and all taxes are due. There's no way to unwind this mistake. Another mistake I see is rushing to buy the wrong replacement property. Even when investors do plan ahead, they often panic when it comes time to find the next property. After all, you've only got 45 days to identify a replacement property and 180 days to close. Sometimes things fall through. I always encourage clients to adopt the mindset that they will close within 45 days. Probably isn't going to happen, but having that outlook early on tends to set the pace for all parties and speed up the final closing. But in a competitive market, that mindset and outlook may not matter, and investors are left scrambling to find something to exchange into, even if it doesn't meet the investment criteria. I've seen investors trade one headache for another. For example, swapping an aging duplex for a newer triplex, but the triplex has a tougher tenant base. Sometimes clients buy out of state without a clear management plan. Other times they just overpay for the property just to avoid losing to the deadline. Scrambling is not a strategy, and for investors looking to retire from active management, this approach doesn't solve anything. So what other options are available? You could still use 1031s, but plan to exchange into DSTs instead of individually owned properties. This is a powerful investment solution that can significantly reshape the approach to real estate investing. Let's discuss the power of DSTs, which is passive income, tax deferral, no management, and higher quality real estate. This is where everything starts to click for high net worth real estate investors. Because most of the time, when people think about a 1031 exchange, they assume they have to go from one property to another, from one tenant headache to another roof loan. But what if you could sell your property, defer the taxes, eliminate the management, and still receive monthly income, and possibly even scale up to institutional grade real estate? That's exactly what a Delaware Statutory Trust allows you to do. A DST is a legally recognized trust structure. Owning fractional shares of the trust represents ownership into professionally managed, income-producing real estate. You're not buying an entire building. You're buying a share of a large statewide real estate asset or portfolio, typically managed by billion-dollar institutional commercial real estate companies. IRS Revenue Ruling 2004-86 states DST 1031 properties will qualify as like-kind exchange property for a 1031 exchange. That means you can sell a property and move your proceeds into a DST while deferring taxes without taking on another hands-on investment. At any given time, there are dozens of DSTs that correspond to most commercial real estate property types. Oftentimes, I've seen the owners of a small to large apartment building sell their property and invest in DSTs that hold higher quality, more stable properties. And some examples of these properties are medical office buildings, triple net lease properties with very long-term leases, industrial properties. Sometimes they even go into another multifamily property, but in a better, higher demand, higher growth market. Every year, DSTs become more commonplace amongst sophisticated investors. We now know that they provide tax deferral through 1031 exchanges, but they also allow for the following: diversification across property types and geographic locations, professional management, no more maintenance, repairs, or tenant works, passive monthly income with potential for long-term appreciation. Lastly, higher quality institutional grade real estate, which even very wealthy people cannot afford on their own. Perhaps the most powerful feature of a 1031 exchange utilizing DSTs is the potential to eliminate capital gains and depreciation or recapture taxes altogether. DSTs normally have 5 to 7 year holding periods before the sponsor liquidates the property and returns the investor's money. At this time, the investor can pay the taxes, 1031 into an individual brick and mortar property, or most likely exchange into another DST. When the owner ultimately passes away, the beneficiaries will get a step up in cost basis, which would create a tax-free gain. The craft term we use in the industry is swap to drop. DSTs are becoming widely used in estate and legacy planning because of this feature. Let's discuss the differences between a good investor and a great one. Many people think it takes a Warren Buffett-like genius. Although that brilliance would be terrific to possess, oftentimes great investors are defined simply by their ability and willingness to plan ahead. The most successful real estate investors I know, they don't wait until they're under pressure to decide what's next. They plan transitions just like they planned acquisitions, strategically, proactively, and with clarity. They understand that real estate is just one part of the puzzle, and when it's time to simplify, retire, or reposition, they want to make that shift without triggering unnecessary taxes or unnecessary stress. The best investors do not sell without a likely landing spot. They don't scramble. Replacement solutions have already been identified. Lastly, they don't treat every sale like a standalone decision. They look at the big picture and how each transaction fits into their overall portfolio of holdings. Many see their wealth compounded when following those principles and using 1031 exchanges. It bears repeating, timing is everything. Do not wait until your sale listing is live to begin planning for a 1031 exchange. The 45-day identification window starts the moment the sale closes, and your choices narrow dramatically under deadline. Some guidelines to follow are: have a qualified intermediary in place ahead of time. Have potential replacement property in mind before sale. And lastly, DSTs are a great potential 1031 exchange vehicle in its own right, but they can also be used to salvage a 1031 exchange. For example, if you're using the 3-property rule, it may be prudent to identify a DST as one of the 3 properties, and it is much easier and more certain to close on a DST if regular real estate falls through. Although tax deferral drives most DST sales, it's important to remember the other benefits as well. Again, DSTs simplify ownership. They create reliable hands-off income. They allow for ownership of higher quality real estate. And lastly, they assist with estate planning. The 1031 isn't just about avoiding taxes. It's about simplifying lives while using your hard-earned assets to work in the manner you want them to. That's the mindset difference. And if you're in that stage of life where control, clarity, and cash flow matter more than property rehab, you're in the exact place where this strategy shines. So here's the bottom line. If you spent your life building wealth through real estate, if you're sitting on appreciated assets but dreading the tad set of selling, and if you're looking for simpler income and less management, the 1031 exchange, especially paired with the DST, is one of several tax-deferred tools high net worth investors may consider. But most successful investors don't guess, they plan. And they use strategies like this not just to save money, but to stay in control of what they've worked hard to build. So if you're approaching a property sale, or even just thinking about simplifying your real estate holdings, book a time with me using a link in the description below. We'll take a close look at your situation and discuss whether a 1031 exchange strategy could be appropriate for your broader financial goals. Because the goal isn't just to avoid taxes, it's to transition wisely and retire with confidence.